Okay, let's unpack this. You log into your brokerage account. Maybe you can get something in the mail, old school, right? And you see a payment, it says dividend.
Mm-hmm.
Or maybe it's a Form 1099 DIV notice, and you think, great, some extra cash. But then maybe the questions start bubbling up. Is it like really free money?
Right.
Is it all taxed the same? What am I actually supposed to do with this piece of paper, this information, come tax time?
Yeah, that confusion is super common.
So today, we're going to cut through that fog. We're diving deep into, well, the sometimes pretty murky waters of dividends and other investment distributions. Our mission for you, the listener, is really to turn that confusing paperwork, those terms, into something clear, something you can actually use, make you feel properly informed.
And what's really fascinating, I think, is just how many different ways your investments can actually send money back to you. And crucially, how each way, each method, comes with its own specific set of rules. So yeah, we're going to clarify those distinctions, from the simple cash payout everyone kind of expects.
Right.
To maybe more complex things like stock distributions, so you understand not just what you got, but really why it matters for your whole financial picture and, let's be honest, your tax bill.
Definitely. And we've sifted through a pretty comprehensive guide on investment income, pulled out the key stuff, the surprising bits to make sure you get that clarity, quickly and confidently. So let's start right at square one. When we say dividend, what are we actually fundamentally talking about? Is it always just like a check from Apple or something?
Not quite, no. At its most basic level, sure, a dividend is a distribution. It could be money, it could be stock, could be other property. And yeah, it's paid by a corporation or maybe a mutual fund. But it's actually broader than that.
Okay.
You could get these distributions from partnerships, estates, trusts, even certain associations if they're taxed, like corporations. And here's a really critical point, something a lot of investors overlook.
Yeah.
Sometimes things called dividends, they're actually interest income, especially from places like credit unions or mutual savings banks. Knowing that difference right from the get-go, that's absolutely key.
Wow. Okay, that's probably an immediate aha moment for a lot of people listening. So beyond that basic idea, what are the main kinds of distributions folks usually see landing in their accounts?
Generally speaking, we usually break it down into three main types. You've got your ordinary dividends, then capital gain distributions, and finally, non-dividend distributions.
Okay.
And yeah, cash is definitely the most common way you'll see these.
Sure.
But they can absolutely show up as more shares of stock or rights to buy stock, maybe other property, or I guess even services in some rare cases.
And how does the IRS track all this? What forms should we be, keeping an eye out for?
Right. So for most dividends from corporations and mutual funds, the main form is the Form 1099 DIV.
Okay, 1099 DIV. Got it.
Definitely keep that. Crucial for your records, even if you don't attach it to your return sometimes. Now, not everything uses that form. For instance, if you're in a partnership or an S-corp, your share of dividends will likely show up on a Schedule K-1.
K-1, right. Seen those.
And sometimes your broker might make what are called payments in lieu of dividends. That happens if they lend out your securities. Those might pop up on a Form 1099 MISC.
Okay, different form again.
Yeah. And here's a really practical tip. Even if, for some reason, you don't get a form, you are still legally required to report all your taxable dividend income.
Ah, the IRS expects you to track it anyway?
Exactly. They expect you to know. And another thing, if you ever get a form and the amount looks wrong, don't just ignore it. Ask the issuer, the company, or fund for a corrected form. It should be clearly marked corrected.
Good advice.
Yeah.
Okay, now here's a scenario that I know trips people up. What if I sell my stock after the company says, okay, we're paying a dividend, but before the actual payment date? Who gets taxed on that dividend?
Yes, the timing trap. This is a classic point of confusion. The dividend income, for tax purposes, goes to the owner of record.
Owner of record. Okay, what does that mean exactly?
It's typically the person whose name is officially on the company's books as owning the stock on a specific date, called the record date, which the company sets.
Ah, so it's not about when the money hits my bank account.
Exactly. It's about who owned it at that specific moment defined by the record date. And speaking of timing, there's this interesting quirk, mostly with mutual funds and REITs, real estate investment trusts.
Right.
It's sometimes called the January rule. If a fund or REIT declares a dividend in, say, October, November, December,
Right, near year end.
payable to shareholders who own shares on a record date in those months, but they don't actually pay it until January of the next year.
Yeah.
You, the shareholder, are still considered to have received it on December 31st of the year it was declared.
Wait, really? So I have to report it on this year's taxes, even though I won't see the cash until next year?
That's exactly right. You report it in the declaration year. It catches so many people off guard and can definitely mess with year-end tax planning if you're not expecting it.
Wow. Okay, that's a huge point. Tax recognition doesn't always follow the cash.
Yeah.
So let's zoom in on the most common type you mentioned. Ordinary dividends. What makes them ordinary?
Well, they're pretty much what they sound like. They're the standard common payouts that come from a company's earnings and profits.
Oh, yeah.
And typically they're treated just like your regular income, like wages, for instance, meaning they don't get those special lower capital gains tax rates.
Great. Standard income tax rates apply.
Exactly. You'll usually see this amount as the main number, often in box 1A, on your 1099 DIV. And generally, unless the company explicitly tells you otherwise, you should assume any dividend you get on common or preferred stock is just that ordinary.
But then there are these things called qualified dividends. You hear about these a lot, often pitched as a big win for investors. What's so special about them?
Ah, yes, qualified dividends. You're right. They can be a significant tax saver. They are actually a subset of those ordinary dividends we just talked about.
Okay, so they start as ordinary.
Right, but the key difference is how they're taxed. They get preferential treatment, taxed at much lower rates, usually 0%, 15%, or 20%, depending on your overall income. These are the same rates used for long-term capital gains.
Which can be a lot lower than regular income tax rates for many people.
Absolutely. It can save you a substantial chunk of change. You'll find these listed separately on your 1099 DIV, usually in box 1B, but remember they're also included in the total ordinary dividends in box 1A.
Okay, so how does a dividend earn this special qualified status?
Well, there are three main hurdles it needs to clear. First, it has to be paid by a U.S. corporation or a specific type of qualified foreign corporation. We can circle back to what that means.
Okay.
Second, it can't be one of the specific types of dividends the IRS says are automatically not qualified.
Right.
And third, and this is the one that often trips people up, you, the investor, have to meet a very specific holding period requirement for the stock.
Ah, the holding period. That sounds like the real catch. Can you break that down for us? What does that actually mean for owning the stock?
Right. Absolutely. This part is crucial. So the general rule is you must have held the stock for more than 60 days during a specific 121-day period.
More than 60 days in a 121-day window.
Yeah.
Okay. When does that window start?
That window begins 60 days before the ex-dividend date.
Ex-dividend date. Remind us what that is.
Sure. The ex-dividend date is simply the first day the stock trades without the right to receive the upcoming dividend payment. If you buy on or after the ex date, the seller gets the dividend, not you.
Got it. So I need to own it for over 60 days in that 121-day period centered around the ex date.
Exactly. So let's play it out. Imagine your 1099 DIV shows an amount in the qualified dividend box, box 1B.
Yep.
But let's say you bought the stock, you had it just long enough to get the dividend, and then you sold it pretty quickly. Maybe you only held it for, say, 34 days total within that 121-day window.
Okay.
Even though box 1B says it's qualified, for your tax return it's actually not. You didn't meet the holding period. You'd need to report it as an ordinary dividend taxed at your regular rate.
Wow. So the form isn't the final word. I have to check my own holding period.
You absolutely do. The IRS's logic here is basically trying to prevent people from just jumping in and out of a stock solely to capture the dividend at a lower tax rate. They want to see you as more of a genuine investor.
Makes sense. They're trying to stop short-term gaming of the system.
Precisely. And just quickly, there are slightly different, usually longer holding period rules for certain types of preferred stock dividends.
Okay. And you mentioned qualified foreign corporations earlier. How does a company outside the U.S. get its dividends qualified for this lower U.S. tax rate?
Good question, because yeah, it's not automatic for just any foreign company. There are basically three ways. One, the company is incorporated in a U.S. possession or territory.
Right.
Two, it's eligible for the benefits of a comprehensive income tax treaty between its home country and the U.S., one that includes information sharing. Think countries like, Canada, the UK, Japan, Germany, many others.
Right, major trading partners.
Exactly. And the third way is if the stock itself is readily tradable on an established U.S. securities market, like listed on the New York Stock Exchange or the NASDAQ.
So easily bought and sold here.
Right. But there's a key exception to all this. if that foreign company happens to be classified as a passive foreign investment company, or PFIC.
The PFIC.
Yeah, it's a specific tax classification. If it's a PFIC, its dividends are never qualified no matter what.
Okay, good to know. So given all those rules, what kinds of dividends are just never qualified, even if, maybe by mistake, they show up in that qualified box on the 1099 DIV?
Right. Even if you see a number in Box 1B, certain things just don't count. Capital gain distributions, for one, they already get capital gains treatment, so they don't need to be qualified again.
Makes sense.
Dividends from, say, mutual savings banks, credit unions, co-ops, those are generally treated as interest income, not dividends for this purpose.
Okay.
Also, dividends from tax-exempt organizations or dividends paid on employer stock held within an ESOP and employee stock ownership plan. Those typically aren't qualified.
Gotcha.
And those payments in lieu of dividends we mentioned earlier, where your broker lent out your shares, those usually aren't qualified either. The big takeaway is really that the 1099 DIV is your starting point, but you, the taxpayer, need to be aware of these rules and ensure everything qualifies that should qualify and nothing qualifies that shouldn't.
It really emphasizes the need to look beyond the numbers on the form sometimes. Okay, let's shift gears a bit. What about reinvesting dividends? Lots of us do that automatically, DRIP plans, mutual fund reinvestment. Seems smart, hands off.
Yeah.
Does that change the tax situation?
Yeah, this is a huge area of misconception. It feels like you're just getting more shares, right? Like maybe it's not taxable until you sell those new shares.
Exactly, that's what I would think.
But nope. If you use your dividends to buy more stock, doesn't matter if it's through a formal DRIP plan or just automatic reinvestment in a mutual fund, you must still report those dividends as income in the year they were constructively received and reinvested.
So even though I never saw the cash, I still owe tax on it.
You got it. The act of reinvesting doesn't make the income disappear for tax purposes. It's treated as if you received the cash and then immediately used it to buy more shares. In fact, it can get even slightly more complicated. If your plan lets you buy those additional shares at a price below the current fair market value, like a discount DRP, you actually have to report the fair market value of those extra shares as dividend income, not just the cash dividend amount. And any service charges deducted by the plan might also technically be dividend income, though potentially deductible elsewhere.
Wow, okay. So reinvesting is convenient, but it definitely doesn't mean you can ignore the tax side in the current year. Good to know. Now, what about those capital gain distributions you mentioned earlier, usually from mutual funds or REITs?
Right. Capital gain distributions. You'll see these reported in a specific box on your 1099 DIV, typically box 2A. The really critical thing to understand here is that these distributions are always treated as long-term capital gains.
Always long-term, even if I only bought the mutual fund like 3 months ago.
Yeah, exactly. It doesn't matter how long you personally have held the shares of the fund or REIT. What matters is that the fund itself held the underlying stocks or assets that generated the gains for more than a year. That long-term character flows through to you.
Ah, okay. That's simpler in a way.
It is. There's also a less common situation called undistributed capital gains. Sometimes a fund or REIT might decide to keep some of its long-term gains and pay the tax on them itself.
Okay, so I don't get the cash.
Correct. But even though you don't get the cash, you still have to report your share of that gain as if you received it. You'll get a different form for this, Form 2439, Notice to Shareholder of Undistributed Long-Term Capital Gains. You report the gain, but you also get a credit for the tax the fund already paid on your behalf.
Interesting. Okay, and then the third main type you mentioned was non-dividend distributions.
Yeah.
That sounds promising, like maybe it's not a dividend at all. Free money.
Huh. It's tempting to think that, isn't it? Non-dividend sounds good, but it's not quite free money. Non-dividend distributions, sometimes called a return of capital, mean the payment is not coming out of the company's current or accumulated earnings and profits.
Okay, so where is it coming from?
Essentially, it's considered a return of your own investment in the company. It shows up in a specific box on the 1099 DIV, usually box 3.
But return of my investment,
Right.
like getting my initial purchase price back piece by piece.
That's exactly the concept. And because it's your own money coming back, it's not taxed immediately as income. Instead, it reduces your cost basis, what you originally paid for the stock, adjusted over time.
So it defers the tax.
Precisely. Let's say you bought stock for $100. You then receive $20 in non-dividend distributions. Your basis drops from $100 down to $80. That $20 isn't taxed yet.
Okay.
Now you keep holding the stock. Let's say you get another $30 non-dividend distribution. Your basis was $80, so the first $80 of this reduces your basis to 0.
Right, basis is now 0.
Exactly. That remaining $10, $90 total received $80 basis is now taxed. Since your basis is zero, any further non-dividend distributions are treated as capital gains in the year you receive them.
Ah, okay. So it's tax-free up to my original investment cost, and then it becomes taxable gain.
You've got it. It's a crucial distinction for tracking your basis accurately over time.
Definitely need good record keeping for that.
Yeah.
Okay, let's touch on a couple more unique situations. What about liquidating distributions? Like when a company is winding down?
Right. Liquidating distributions happen during a partial or complete liquidation or shutdown of a corporation. Tax-wise, they work very similarly to those non-dividend distributions we just discussed.
Meaning return of capital first.
Exactly. They're treated primarily as a return of your capital, reducing your stock basis dollar for dollar. You'll often see these amounts reported on your 1099 DIV too, sometimes mixed with regular dividends if the company still had earnings. So, again, no tax until your basis hits zero. Any amount you receive after your basis is zero is reported as a capital gain, and whether that gain is long-term or short-term depends, as usual, on how long you held the stock before the distribution.
Makes sense. And what if?
Yeah.
What if the total I get back from liquidation is actually less than what I originally paid for the stock? Less than my basis?
Good question. If the total liquidating distributions end up being less than your adjusted basis, you might actually have a capital loss.
Okay, a loss. When can I claim that?
You can usually only claim that capital loss after you've received the final liquidating distribution, the one that fully redeems or cancels your shares, not typically piece by piece.
Got it. Wait for the final payout. Okay, now for one that really surprises people.
Yeah.
You mentioned stock dividends earlier, getting more shares instead of cash. And you said they're often not taxable. Is that really right?
Yes, that's generally true, and it definitely catches people off guard. Distributions a corporation makes of its own stock or rights to acquire its stock are typically not taxable to you when you receive them.
So I get more shares, my total value might go up, but I don't owe tax right away.
Correct. You don't report it as income on your return. What you do need to do is adjust the cost basis of your shares. Essentially, you spread your original cost basis over the larger number of shares you now own, resulting in a lower basis per share.
Okay, basis adjustment, not immediate tax. But, I sense a but coming. When are stock dividends taxable?
You sensed right. There are several important exceptions where stock dividend is taxable. This is where it gets tricky. It's generally taxable if it feels too much like getting cash.
Like how?
For instance, if any shareholder had the choice, even if you didn't take it, to receive cash or other property instead of the stock.
The choice makes it taxable.
Right. Or if the distribution results in some shareholders getting cash or property, while others who get stock end up increasing their proportionate ownership interest in the company.
Okay, so if it changes the ownership percentages unfairly.
Exactly. Also, if the distribution involves convertible preferred stock and has a similar result, or if some common shareholders get preferred stock while others get common stock. Basically, if the distribution isn't proportional or gives shareholders different kinds of outcomes, it's likely taxable.
So, simple. Across the board, stock splits or dividends are usually okay. But anything fancier needs scrutiny.
That's a good way to think about it. And one other thing, sometimes you get cash for fractional shares in a stock dividend because they can't issue, zero point 0.7 shares. That small cash payment is treated like you sold that fraction, so you'd report that tiny sale.
Got it. Okay, this is incredibly detailed. Are there any other sort of less common distribution types we should just be aware of?
Yeah, just quickly for breadth, you might see exempt interest dividends on your 1099 DIV, usually from municipal bond funds.
Exempt interest, meaning not taxed.
Correct. They're generally not included in your regular taxable income, which is the main appeal. But you still have to report them on your tax return, usually on Form 1040. And importantly, they might be subject to the alternative minimum tax, the AMT.
The AMT wrinkle.
Okay? Then there are dividends on insurance policies. Usually, if you just use them to reduce your premiums or if they're considered a return of premiums paid, they're not taxable up to the total amount of premiums you've paid. But any interest the insurance company pays you on dividends, you leave sitting with them. That interest is taxable.
Okay, distinction between the dividend itself and interest earned on it.
Right. And for veterans, any dividends on veterans insurance are never taxable. Simple as that.
Mm-hmm.
Also, maybe Alaska Permanent Fund dividends, if you happen to live in Alaska.
Yep.
Those are not treated as dividends for federal tax purposes at all. They're considered government payments to residents and get reported separately as other income. So, yeah, if we kind of zoom out for a second, These examples just hammer home how nuanced that word dividend can be, right? You really have to look at the specific source, the context, the nature of the payment, not just the label, to figure out the tax treatment.
Absolutely. That's a fantastic summary of the complexity. Okay, so we've covered the waterfront on types and nuances. Now let's bring it back to the practical side. How do we actually report all this stuff when we sit down to do our taxes?
Right, the brass tacks. So your total ordinary dividends, that amount usually goes right onto the main income section of your Form 1040 or 1040 SR, line 3B.
Okay, line 3B for ordinary.
Your qualified dividends, if you have any, are reported on line 3A. But remember, that qualified amount is already included in the total on line 3B. Line 3A is just breaking out the portion that gets the lower tax rate.
Got it. Do I always need to attach extra forms?
You'll need to file Schedule B, Form 1040, specifically if your total ordinary dividends are more than $1,500 for the year.
Okay, $1,500 is the threshold.
Right. Or you also need Schedule B if you receive dividends as a nominee, meaning it was reported under your Social Security number, but it actually belongs to someone else.
The nominee situation. We'll come back to that. Now, this raises an important question.
Yeah.
What about dividends paid on restricted stock, like stock you get as part of your job compensation?
Excellent point. That's often handled differently. Dividends paid on restricted stock before it vests are generally treated as additional compensation.
So like wages, not dividends.
Exactly. They'll usually be included on your Form W-2 from your employer, subject to regular income tax withholding, Social Security, Medicare, all of that. Not reported on a 1099 DIV unless you've made a specific tax election called an 83B election when you receive the stock. That changes things, but for most people, restricted stock dividends before vesting wages.
That's a really key distinction for employees with stock comp. Okay, what else on reporting?
Well, if you do have qualified dividends or long-term capital gain distributions, you'll likely need to use the Qualified Dividends and Capital Gain Tax Worksheet found in the Form 1040 instructions, or maybe Schedule D, to figure out your tax correctly using those lower rates.
The worksheet. Okay.
Capital gain distributions themselves, those amounts from Box 2A on the 1099 DIV generally flow to Schedule D or sometimes directly onto Form 1040 if Schedule D isn't otherwise needed. And those non-dividend distributions, the return of capital. Remember, you don't report those as income until your basis is zero. Once basis is zero, subsequent payments get reported as capital gains, usually on Form 8949 and Schedule D.
Okay, basis tracking is key there. And back to the nominee situation.
Yeah.
If I get a 1099 DIV for dividends that belong to my kid or someone else.
Right. So if you receive dividends as a nominee, you first report the full amount shown on the 1099 DIV you received on your Schedule B. Then on that same Schedule B, you subtract the amount that actually belongs to the other person, labeling it as a nominee distribution.
Okay, so it washes out on my return.
Correct. But your job isn't done. You then also have a responsibility to file your own Form 1099 DIV with the IRS, reporting the dividends under the actual owner's name and Social Security number. And you need to provide a copy of that 1099 DIV to the actual owner. There are deadlines for this, usually end of January for the recipient copy and end of February-March for the IRS filing.
Wow, okay. That's a significant responsibility, making sure the IRS knows who truly received the income.
Absolutely. It ensures the correct person reports it and pays tax on it.
Phew. Okay, we have covered a ton of ground here. We really took a deep dive into what on the surface seems like a simple topic, getting a dividend payment.
Yeah.
But as we've clearly seen, these distributions come in so many flavors, right?
Yeah.
Each with its own very specific rules and, importantly, its own tax impact.
Yeah, absolutely. And if we sort of connect all these dots back to the bigger picture,
Right.
truly understanding these nuances, I mean, everything from hitting that holding period for qualified dividends to unlock the lower tax rates, to knowing how non-dividend distributions affect your cost basis, it really does empower you as an investor.
Yeah, you can see that.
It lets you manage your investment income correctly, helps you avoid those nasty surprises come April 15th, and honestly, it can even help shape your actual investment strategy. It boils down to recognizing that not all income is taxed the same way, and that difference can have a really significant impact on your bottom line, your overall financial outcome.
So thinking about the listener, what does this all mean for you? Maybe the next time you get any kind of distribution, whether it's that straightforward cash dividend or something more complex like a stock right or a liquidating payment, maybe pause and think. Consider not just the dollar amount, but its type. Where did it come from? How might knowing these details actually change how you look at a potential new investment, or how you evaluate the stocks you already own, or even just how you plan your finances around year end? Could holding a stock just a few weeks longer actually make a meaningful difference to your tax bill because of that qualified dividend rule?
Those are exactly the right questions to ask.
Definitely. And the practical advice holds. Always keep those Form 1099 DIVs, keep the Schedule K-1s, any Form 2439s, all those statements. Keep them organized. And look, we've covered a lot, but this stuff can get complicated, especially with individual situations. So never hesitate to dig into the official IRS publications. They have detailed guides, or even better, talk to a trusted tax professional for advice tailored specifically to you.
Couldn't agree more.
Well, thank you so much for joining us on this deep dive today. We really hope this helps demystify the world of dividends. Keep learning, stay informed, and we'll talk to you next time.